the risk rally in March, we're not even March, in January, did it run too far?
Well, clearly it has run a little bit out of steam. As you said, really since the unemployment data on the 3rd of February out of the US, the market has taken a little bit of a hold. Let's remember, we've seen a relatively strong rally since the peaks in October. Investment grade indices across the world from that point are still 50 basis points tighter than we were at the time. And the market is, worrying exactly about the points that you were mentioning earlier. There are a lot of signs that the economy is still running relatively strong, and that obviously puts pressure on inflation remaining high and central banks potentially having to do more.
What do you make, though, of junk debt, of high yield debt also not doing well? Because obviously it's less policy sensitive. Some of the ETFs, investors pulled over $6 billion from a U.S. high yield bond fund last week. So we are seeing steady outflows there, but that's not really as much where you'd expect it if it is a rate story.
Yes. The leveraged debt space definitely, is slightly more challenged than the investment grade side. Although having said that, we are very happy to see that since October, November, also that market has started going a little bit. But what's very clear is that in the new environment of higher rates, leverage is slightly more restricted for leveraged borrowers, and that needs to be managed.
Yeah, I've had a lot of conversations, we were talking about this in the break, with private equity folks who've said, I found really attractive deals, but I haven't been able to do them because financing is so hard to come by. When does that market open up again? Not that it's necessarily completely closed, but when does it start to ramp up again to more normal levels?
Well, the question is whether this is the new normal. Really, we've seen since the financial crisis in 2007, 2008, that rates were super low, liquidity was ample and maybe more than what is normal. And right now we need to adjust what we're facing at the moment. If we are in an environment where inflation is structurally at sort of 2 to 3%, then leverage levels being a little bit more constrained and costs for leverage finance being higher, people have to accept that that's the new normal. It is actually very interesting that is one of the reasons why we feel investment grade corporates at the moment are extremely strongly positioned, because they were facing the competition from the private equity world in the last decade, and it's a bit more of a level playing field now.
So does that mean your appetite to lend, it's still there, it's just only with those corporates with healthy balance sheets then?
Well, we've come through the last sort of 9 months very well in terms of our own lending, especially also in the leverage finance space. So our bridge book is clean, and we are able to be very proactive. That doesn't only mean that we're only supporting investment grade corporates, but we're very much open for business on the leverage finance side, but we are picking our spots a bit more in that space.
What becomes your playbook when there's still that so much unknown, everything from energy to war to rates? There's still so much unknown out there.
So what we're telling our clients is you need to make use of the good windows of the market. So we told everybody to be on it as we were going through January, and that really worked. Risk products, hybrids, long-dated transactions went really well. And that's really what you need to do for the remainder of the year. There will be periods that are softer. Right now, I'd say we are sort of calibrating and we're finally balanced. There'll be soft spots in the market, which you want to avoid. And then you make use of the good windows. You just have to be ready.
Okay.
Get on with it and be ready.